Have you ever pondered the gravity of a single decision? Can a mere choice, seemingly insignificant in the grand scheme of things, wreak havoc on a global scale? Welcome to the world of accounting, a realm where the smallest of decisions can lead to monumental consequences. Today, we'll explore the importance of ethics in accounting, a topic that's both intriguing and vital to understanding this profession. Consider the case of Enron, a once vibrant energy giant that crumbled under the weight of its own malfeasance. A company that, at its peak, boasted a market value of $70 billion, brought to its knees by the unethical practices of its accountants. Enron's fall was not an overnight catastrophe. It was the result of a series of unethical decisions, each one compounding the damage of the last, ultimately leading to one of the most infamous bankruptcies in history. Now, imagine this. Enron was not an isolated case. In fact, the early 21st century was marred by a series of similar scandals. WorldCom, Tyco, and Adelphia Communications, to name a few, each fell victim to the same destructive path. These were not small companies. These were industry leaders, economic powerhouses that employed thousands of people and influenced economies around the globe. Their downfall was not just a corporate catastrophe, it was a societal disaster. Why did this happen, and how can we prevent such disasters from recurring? The answer lies in the power of ethics, the moral compass that guides every decision we make. In accounting, this compass is of paramount importance. It's not just about balancing the books. It's about ensuring the integrity of those books. It's about transparency, responsibility, and trust. Following the wave of scandals, lawmakers took action, introducing the Sarbanes-Oxley Act in 2002. This act significantly reinforced the ethical standards in accounting. It demanded greater transparency, imposed stricter penalties for fraud, and pushed for increased responsibility among corporate executives. The Sarbanes-Oxley Act was a wake-up call for the accounting profession. It underscored the importance of ethics in accounting, highlighting the dire consequences of unethical practices. It served as a reminder that accountants are not just number crunchers. They are gatekeepers of trust, custodians of integrity, and protectors of economic stability. So to summarize, ethics in accounting is not just a theoretical concept. It's a practical necessity, a guiding principle that can mean the difference between success and failure, between trust and betrayal. The case studies of Enron, WorldCom, Tyco, and Adelphia Communications vividly illustrate the devastating consequences of ignoring these principles. And the Sarbanes-Oxley Act serves as a potent reminder of the importance of maintaining ethical standards. As we delve deeper into the world of accounting, remember this: every decision matters, every choice has consequences. And in the realm of accounting, the ethics behind these choices can shape the fate of entire economies. So, let's tread carefully, act responsibly, and uphold the highest standards of integrity. Because in the end, it's not just about the numbers, it's about the principles that guide them.